the concept of a 1031 exchange comes up a lot. And what's involved with a 1031 exchange is that you sell one property, or you exchange one property, let's call it property number one, into property number two. The mechanics of that is that at the escrow company, you set up an exchange trust. The proceeds from the sale of property number one go into this exchange trust at the escrow company, and then that exchange trust purchases property number two for you on your behalf, and then title is in your name. So that's the mechanics of how the tax-free exchange. Why do people do it? Let's say in property number one, you've purchased the property for $800,000, and now you've used depreciation, and now your tax costs, let's say it's $500,000, and now that property is worth $1.1 million. Well, if you go to sell that property number one, you're going to have a gain of $600,000, and you're going to have to pay taxes on $600,000. Let's say the taxes on that are $200,000. Now you're only going to have $900,000 to exchange into property number, or to purchase property number two if you do not do the exchange. But if you do a tax-free exchange, you'll have the full $1.1 million from property number one to go and purchase a property number two for $1.1 million. So the advantage is you have more money available by doing the tax-free exchange to purchase another property. But what some people don't understand is that, again, let's say my property is, I bought for $800,000. Now I've depreciated it down to $500,000. It's worth $1.1, and now I go and buy a second or do an exchange for a second property for $1.1. Well, now my tax basis in that property number two that I did an exchange for $1.1 is the same as property number one, or $500,000. So you're not getting away with not having to pay any taxes. Property number two tax basis is now not $1.1 million, because that's what you paid for it. It's going to be the $500,000 of property number one that you did the exchange for. And so really, sometimes these 1031s are called tax deferred exchanges, because you're really deferring the tax that you didn't have to pay on property number one. So, but you're getting the advantage, again, in my example, of being able to use $1.1 million to go out and buy property number two, versus $900,000 if you were to sell property number one and use the after-tax proceeds to go find another property. There's a couple requirements of a 1031 exchange. One requirement is that you identify a replacement property number two within 45 days that you close property number one, and you have to send a formal statement to the person that's in charge of the escrow exchange, the 1031 exchange, and list the property, identify the property within 45 days from the time that you close property number one. The second requirement is that you have to close property number two within 180 days that you closed property number one. So two requirements: identify within 45 days and close within 180 days. There is one more advantage of a 1031 exchange. So let's say that you have your property number one, your tax basis is $500, it's worth $1.1, and you do the exchange into property number two. Now property number two is worth $1.1, your tax basis is $500,000. So if you go to sell that property, you're gonna, for $1.1, you're gonna have a gain of $600,000. One exception to that is if you die, unfortunately, then your heirs will now get a cost basis in property number two of $1.1 million. So people ask me, how do I get out of these taxes? And I tell them, well, I've got a way, but you're not going to like the answer. The answer is, if you die, your heirs get a step up to $1.1 million and don't have to pay any taxes.